Talk about diversification. Kind of explain it to me, if you would.
So diversification, and let's face it, market is going to ebb and flow, and that's what it does. The market's going to go up 10%. It's going to go down 10%. The market's going to go up 15%. It's going to go down 15%, and that's pretty normal. What's not normal is when the market is down 30, 40, 50%. That's unusual. So you had used that word, quote unquote, diversified. And most people are using what we call standard diversification. That's when instead of investing in one stock or one mutual fund, they invest in 15. But Dad, where is a stock sold? Where is a mutual fund sold?
It's sold in the market, which means you have basically dollars that can go up and dollars that can go down.
So traditional diversification is where you have a whole bunch of these things, but certain ones will go up at certain rates and certain ones will go down at certain rates. But typically they all go down at the same time.
Yeah,
just different ways.
Yeah, diversification would be having some money in all categories. You have money that are safe, they can't go down regardless of what comes out of Wall Street, and you have money that is in the market. But you have to have a combination to have a solid diversification.
But what you're talking about is true diversification, which is different than standard traditional diversification that was been taught to me when I went to college, and they just said own 15 stocks instead of one.
How many times people will have 8 or 9 different mutual funds, and when you come in and you look at when there's a stress test ran, and you see where in that mutual fund they're invested, they all have Disney. They all have. Yeah, they're all in the same category.
Overlap.
Different company,
right.
but still in the same investment.
So certainly we've heard about diversity for a long time and being able to diversify our monies. And as you said, Nick, I mean, the old way is just, you've got 15 stocks or 15 different mutual funds, but they're all in the same kind of category. So that's a challenge. But diversification is a key, as Jerry pointed out. It's not being all in the same place. Your money's in different places. What else beyond diversification can someone do to help protect their money, but still get some decent growth on their money?
So if we were to call level 1 entry-level investing diversification, that would be investing like we had just talked about. Don't invest in one stock, invest in 15, or don't invest in one mutual fund, invest in 15, whatever. That's what we would call level 1, entry-level diversification. Let's kick it up a notch. Let's call the next step up level 2 investing, where you integrate in alternative investments into your portfolio. Investments that aren't just tied to each day or each tick-by-tick move of the stock market. All right? It's alternative to that. And then let's go up another level. And then the next level up from that is we call this level 3 investing, which is where you are diversifying some of your money using maybe the first level where you're diversifying, the second level where you're using alternatives, and then that third level where you're investing in principal protected investments for some of your money. Now, level 3, this is principal protected growth. This is where you can earn money, but then those gains can be locked in. And if the market heads down, your principal, maybe even some of your gains, are protected from market loss.
Yeah, and we don't know what the stock market's going to hold in the next 6 months or a year. But what we do know is that right now there is a window of opportunity to put together an ideal financial plan that can realign your risk like we've been talking about during the program today, to protect you against both good and sour markets.